Ignite your curiosity with Austin Next. We're watching Austin transform from a thriving ecosystem into a global superstar. With our host, Jason Scharf, we aspire to better comprehend the true nature of innovation. Together, we will uncover what makes a successful ecosystem and navigate the technologies shaping our future. Now let's dive into what's next.
Just like angels from heaven, angel investors come in early and bestow grace onto startups, or at least that's how it's supposed to work. Angel investing in practice is a lot more complicated and complex than how it sounds on paper. From single individuals writing massive checks to small players trying to get in on the ground floor to entire groups dedicated to the idea and pooling capital. Joining me today are Katie Russel of the Central Texas Angel Network, Hall Martin of 10 Capital, and James Burkett of NuFund to break down all the ins and outs of investing at this stage and what specifically is happening in Austin. Start off with kind of telling us who you are and the organizations you represent. So, Katie, why don't you kick us off?
Sure. My name is Katie Russel. I'm the executive director at Central Texas Angel Network, also known as CTAN. We're one of the leading angel networks in the country. We focus on supporting early stage entrepreneurs with investors, but not just capital, also strategic guidance. We're based here in Austin, Texas, and we've been here since 2006. We've invested $133 million into 219 companies to date.
Yes, I'm Hall Martin. I'm the CEO of 10 Capital. I've been angel investing for 21 years and have been working with 10 Capital for the last 14 years, working with startups and investors in the angel space.
Awesome, and I will go next. My name is James Burkett. My day job is actually as a co-founder of an international investment fund called Florin Digital. We spend our time investing in crypto and blockchain startups. But the point of me being on today is I'm also the founder of the NuFund cohort in Austin, Texas. And so NuFund is an angel network that was predominantly based in Southern California and New York City. As part of COVID, as everyone kind of knows, that whole space and that whole process was a bit disrupted. And so now we have members across the United States. NuFund focuses predominantly on seed and pre-seed deals, software, biotech, hardware, and has invested in well over 100 companies since they've been founded.
To put a little bit of transparency out there, NuFund, as it was known as TCA back in the day, San Diego is how I kind of got cut my teeth on angel investing back in San Diego. So it's all coming full circle. I feel like you're following me around. So kind of wanted to start off kind of in the big picture. What do we think about the role of angel investing and angel capital in an innovation ecosystem? I mean, is it just checks, or how are we thinking about this? Katie, why don't you kind of start us off?
Yeah, sure, I can do that. So I think angel investing is super important to drive early stage innovation and growth to help the region grow specifically. And so while we're writing checks, I think it's really important, especially for early stage founders, especially early stage founders who don't have capital to individual angels. And so I think we'll get into it later in the episode, but angel networks are really meant to be pools of investors who can provide capital to founders. But it's not just those first checks, while that's probably one of the most important things. It's also having tons of different angels on your cap table who can help support you while you're still in the very early stages of growth. And so I think that's where angel networks come in. You're not just going to a pre-seed fund and getting a check and they're sending you along their way for your next rounds, but they really open up their Rolodexes to everyone in their network. And because angel investors and angel networks specifically have so many different members with diverse backgrounds, they're really able to help a company at the early stage, almost in any area that they need, because they do have such a diversity of backgrounds there. So I think it's really important for every city to have their own angel network. And, here in CTAN, we see tons of startups coming from Austin specifically, also Texas and all across the country. So that's really what we focus on, is providing the capital, but then also making sure that they have tons of support in whatever area they need post-investment.
I think I'd echo a lot of what Katie said. Is this is really the first check-in. This is the most foundational capital these people, these companies will ever receive. I mean, and these are very much living, breathing organisms as they go. This may be a Delaware C corp, but it needs to be helped and brought up to speed and massaged all along the way. And that's what really the function of, I think, having angels, having a really active angel population and having these angel groups does. instead of just me, my Rolodex, you can get 20, 30, 50, 100 members who all have, really incredible personal experiences, really incredible professional experiences, and you can leverage that in the earliest days of a startup.
Yeah, and I just pile on that and basically say I think angel investing fills the gap between the family and friends funding and institutional funding. There's a pretty wide gap there that has to be filled with some growth and business development. And while the angels can also put in money, they can also provide networking and mentorship. And it most often comes in the form of helping them, that company, find more customers and find more team members. And oftentimes partners are a key part of that as well. That's where I see them adding most of the value.
So when you picture an angel in each of your guys' head, who is it? Who is it that you're kind of picturing? Is it ex-startup founders? Is it people in the ecosystem in terms of working at larger companies? Is it people outside of tech? And I'll use that broadly. Like, what is it that you kind of have in mind? James?
I would say for me, it's different strokes for what you're looking for. If you have an incredibly technical founder, maybe they're looking for someone who can support them from a biz dev perspective. If you have a business savvy founder that needs a co-founder or needs technical support, if you have, I don't know that there's a perfect cookie cutter example for what I think of an angel, but at least someone who's able to write a small, call it $10,000 to $50,000 check to be part of your cap table, but then also be an advisor. And so this is probably a high net worth or relatively successful person in their personal careers, but someone who's active in the ecosystem, who's active and can actually provide connections, not just someone who can cut a check that you'll never see again.
But does every angel, and it's funny because all of you kind of talked a lot about the help that angels can provide, but does every angel have to be an advisor? And I'm thinking both from the angel side and from the founder side. And a lot of, let's be honest, a lot of help is not really helpful.
I actually think that's a really great differentiation. Like, these are not people who should run your business. These are not people who you would want to be your executive assistant. This is someone where you have maybe 2 arrows, 3 arrows, where you can ask 2 or 3 questions and get from this person. This is not someone you want hands-on every single day. But you want that line to be open if you ever need them to call or an intro or how you really bridge the gap to the next level, at least in my view.
Yeah, I think from my perspective, before being part of an angel network, I always thought of angel investors as high net worth individuals who you knew personally or you got connected to. They really liked you. They bought into your idea and they invested. After joining CTAN, I think my definition of an angel investor has changed drastically. Now I think of angel investors as people who have had success in their careers, which are all different types of careers. So that could be, lawyers, physicians, oil and gas, maybe some people who are running their family offices or VC funds, but really expert investors are, I would say, the minority of what our group's made up of. And so when you have a deal come in and you're writing or you're getting checks from all these individual people, you of course don't need advice from all these individuals, but when you get to certain stages of your business, there's going to be people who have that background and expertise who can step up to help you because they're part of the network, because you're now a portfolio company of CTAN. And so I think that's really when we look at our members, most of them do not come in and they're saying, hey, we're expert investors and now we want to be part of an angel network because we need more deal flow. That's just not the case. It's typically people who want to get into startup investing. They don't have the formal background. They want to lean on an angel network that has consistent, structured processes, and they can leverage the expertise of all the other members. And then from there, when we do make an investment, the teams that we're forming around due diligence are typically where our experts really come out of the pack and are helping us to conduct that due diligence. And then if we do make a significant investment, that's where they're signing up to be advisors or board members. But it's not the whole group, sending emails about perspectives on how you should run your business. So I think from an angel network perspective, we think of it a bit differently.
Yeah, I echo that. I think it's successful business people that want to diversify their investments, and they typically have experience and mentorship that they can share with others and leverage into it, or they have a network that can also be helpful to find more investors or more support for the startup. So there are people that want to work with startups and they believe in the opportunity that it brings.
So we talked a little bit about, Katie, I mean, you mentioned that, it was the image was this originally the high net worth individual and being able to, they believe in you and they're writing these checks. And a lot of times we kind of think of them almost, the word comes like super angel, right? So you have these kind of the individual angels, you have these angel groups, you have super angels, you kind of these ad hoc syndicates that come together. And then you even have like the pre-seed venture funds. how do all these different groups kind of come together and play in the angel pre-seed environment? I mean, are they playing in the same pond, or is it really they're really different layers of the ecosystem? It's different founders are going to them. How are you seeing that play out?
I think it's everybody has their own different motivation, their own investment strategy, their own focus, their own interests. And so when you think of super angels, I think of it more as, mega high net worth individuals. They know what they're looking for. They have capital to spend. They find entrepreneurs that they're passionate about or that they really like and they invest. And then you have your individual angels. And this is actually funny. So the individual angels will go, they'll find a founder, they'll maybe write a check. That's actually the most likely member archetype for CTAN is those individual angels who have tried to go out and do it on their own and they get burned because unless you know exactly what you're looking for and you probably have an investment background, it's just going to be somebody in your network, maybe your friend's daughter coming up to you asking you to write a check, but you're not sure how to evaluate the deal. And so they're writing maybe 5 checks, they're getting burned, and then they're realizing, hey, I need to join an angel network because I need to learn more about investment. I need to actually construct my portfolio thesis, and I want to lean on the expertise of all the other members who are part of the network. So I think everybody has their different motivations, and syndicates, I think that's case by case basis. So it really depends. And also all angel networks, they all have their own different criteria for what they look for. We're generalists, so we look at everything, but that's because we have a strong network of members who come from such a diverse background that when deals do come in, we're able to evaluate those effectively based on their experience. And so I'll just wrap it up with it's really motivated by each individual and what they're looking to get out of the deal.
But I'm thinking, Hall, maybe thinking to you for a second, when we think about the flipping on it from the other side, from the startup perspective, are we looking at different types of deals that they're flowing to these different types of angels, right? I mean, is the multi-time founder more likely going to the super angels or the kind of the ad hoc syndicates and the pre-seed funds? And is it the early time founder who hasn't kind of done this before heading to the angel groups? How are you seeing kind of the deal flow occurring?
Sure. So I think startups often find their first checks from individual angels who have a very light diligence process. We just believe in the team and I like this guy. And they'll write the check and, the entrepreneur will sign the convertible note and that money goes into the business the next day. And that's how a lot of these guys get to, kick it off is they got some money they can start to do things with. The super angel is more formal. They'll do more diligence. They'll actually lead deals, but they also want higher returns, but they're also going to put more into it in the form of support and ongoing. So I think starts with the individual angel, but it gravitates to the super angel who will do more for them as well.
But do you see a lot of overlap between the different groups? I mean, do you see people who are getting, say, like super angels and ex-founders coming to the angel groups as well? Or do you see these kind of operating almost in different areas of the ecosystem?
I think some angel groups have a mixture of all of those in there. And so you do see a mixture of those coming in. I find startups typically approach individual angels first, and then they approach angel groups second because the individuals are easier to close, get some traction. You can show that other people are in the deal. And angel groups like that validation before you go through them. And then super angels are the same way. They're looking to see if other people are in the deal, and then they're willing to put more into it once they see that there's a group forming around it that they can be a part of.
So, James, where do you come in this? You mentioned that you're one of the jobs obviously is you're running a fund, but then being part of an angel group. How do you kind of balance and think about those two different things?
So I would say that from a fund perspective and as an individual angel, definitely the propensity for risk is a bit higher than what we see get through angel groups. And I think you hit the nail on the head a little bit, maybe without saying it directly, is that there is some selection bias. Sometimes I think that's a good selection bias. So it's not necessarily, hey, we're missing all of these really great deals because we're in an angel group. I think they have a lot of tried and true processes that makes sense. Where we start to see issues is when processes become rigid to where you're checking a box. I mean, in defense of angel groups, look at some of the most successful accelerators of all time. They say, hey, we'll give you, $500K for 25% of your business. A really successful entrepreneur doesn't want that. They can go raise from super angels on a better level. But maybe there's some other components that they like. And so it's really being really deliberate about what capital you're looking for how they can provide it and who they will provide it to, I think is probably the biggest question in my mind from an entrepreneur's perspective.
One of the reasons you said that we have people kind of moving from the individual angel into the angel group is that they want the exposure. They've been burned by, not having the process, not having the diligence and kind of the group around them. Should some of these people even be pickers? I mean, it's a question, right? Like, are there as angels versus LPs, and thinking about different ways that people should have access and be driving into capital versus actually being the ones who are making the selections, right? I mean, there's one thing about, hey, me personally, I would love to diversify my portfolio into sectors that I know nothing about, and I should in no way be selecting into ag tech as an example, right? Like, that's not an area I should be touching, but might be an interesting area to have some exposure to. Like, how do you think about that, especially in the kind of using startups as a way, as someone's got a large background in corporates, might want exposure to this, but joining an angel group and being part as a selector rather than being an LP might be a better way to go.
Yeah, I think it's a huge, huge advantage to be part of an angel group. I don't think the right metric to look at is, should you be a professional investor to be joining an angel group? Everybody, if you think of like a general fund, right, there's probably 3 partners that are making the decision. And you look at an angel group and there's 140 people across all different backgrounds who are collectively making decisions and eliminating companies at each step. And so it's almost like you're getting better investment decisions, even though not everybody's an expert in that industry. You do have the experts, and you're able to lean on each other's backgrounds and to evaluate a deal effectively. I mean, there's so many times where we'll go to a pitch night, and I think there was one case where somebody was pitching about an orchard, and somebody actually ran an orchard, and so it's just those individualized experiences where if you took that to a fund, yeah, you have 3 people making the selection, but is that the right way to look at it too? And so joining an angel network, you get a lot more just opinion and expertise in different industries across, so many different industries. And us being generalists, I think that's the perfect way to look at it. So from my perspective, you shouldn't be picking just expert investors to be making those decisions, but that's the benefit of an angel network. And then especially if you do have the structured, consistent processes, every angel network operates entirely differently. And so if you're just having a couple people from your network picking the deals, then you're operating more like a fund. If you're taking everybody's collective opinion and you have a way to move people through a deal effectively, then that's where you'll see the highest returns.
So I want to pull that apart in 2 ways. One, the orchard deal was interesting. Didn't then, though, everybody just acquiesce to the person who ran the orchard? So didn't you end up not having large amount of different inputs, but you had one person? I'm curious, did you have one person making essentially the decision for the group because that person had the background?
So what comes into play with a lot of the deals is there's lots of industries out there. Everybody's an expert in their own space. And so with this particular deal, the problem that they were trying to solve, that person came in and said, hey, I've been doing this my entire life. These are the issues that we're going to run into. So if this company makes it to due diligence, this is what we need to focus on. And these are the holes that I can pick in their business model, which is incredibly valuable to have. So it didn't kill the deal, but because we do all of our own due diligence as a group, it helped us figure out the areas that we need to focus on, where if there wasn't an industry expert in the room, we might have just grazed past that and thought, oh, this is something that's solving a true problem. And so it doesn't kill the deal. It just highlights some areas that we need to dive deeper into to figure out how they're solving them before we write checks.
I think that's really well said. It takes the SME component out of it, out of due diligence. You're not having these extensive subject matter expert calls. You're just using the wisdom of the crowd, the wisdom of the group, and that's something really, really powerful that if angel groups aren't leveraging, they should be, because you have a lot of people with really diverse backgrounds and diverse expertise, and so if you're not using that to your advantage and making better investment decisions, shame on you, I think.
How do you think about wisdom of the crowds, though, as it comes to, especially in venture investing, you're going to find outsized returns with contrarian thinking, and wisdom of the crowds cannot, by its nature, be giving you contrarian thinking.
If you're right, I mean, you can be
course,
contrarian.
yes, you have to be. You're absolutely right. You have to be right. But you're not going to get that. You're going to get, non-contrarian, smaller, on trend with wisdom of the crowd. That is what you will get with that model.
I can't speak for others. I do think that there is the self-awareness with NuFund, with really a lot of investors, a lot of angel investors that I've seen that they don't know what they don't know, and they are absolutely open to something different. They're open to being wrong, and that self-reflection has to be a huge part of your investment process, or you're going to keep missing the same thing. I'm sure everybody in this call has an example of where they were so smart, they knew everything was right, and they missed the 500x. And taking really, really deep reflection and making sure, hey, I did actually make the correct decision, or hey, I have this blind spot, is an important process. And so it's all about what you get right, but also evaluating what you missed and what you could get right the next iteration, I guess. And that is something that I think we take very seriously, because if you're not growing from that, again, you're just leaving meat on the bone.
Go ahead,
And
Hall.
from my side, I'd say it just depends on where you find the expertise. Is it in that angel network? Well, join. If it's not, but it's rather in that fund and all the LPs know something about it, and if I join that group, I'll learn and I'll be able to figure out, through their network, I'll do that as well. So both have kind of a networking component to it. I find most funds have a set of days where people come together where you can learn about what's going on, and you can also share your experience back with the group as well. So it just depends. And some technologies really require a deep dive. Some of these things in deep tech, blockchain, quantum, really, I don't know if wisdom of the crowds is going to get it right in that case. But if it's other things, enterprise software, et cetera, well, then wisdom of the crowds starts to bear more fruit. So it's just one way to look at it, is where the expertise is where to go.
Yeah, if you're seeing the 100th SaaS company, then yeah, probably the wisdom of the crowds is the reasonable path to go. I mean, one of the things that I struggle with, and this is going as someone who's been involved in angel groups and angel funding, is that and this comes from a place of me wanting them to be better and wanting them to be in a very important part of ecosystems. Is I think there tends to be two areas that I think that they struggle in, and this is why, and it's not me wanting to be overly combative in this. Is one is that I don't think that they tend to be responsive to the needs of startups in terms of the speed. I think they tend to be overly process driven and slow, which then part of that creates a adverse selection, right? And this is back to our kind of wisdom of the crowds. I've seen that the top level deals don't go through angel groups. And so you don't see those kind of, if you kind of look back, they tend to be more towards the super angels or the pre-seeds funds. And so it's this interesting question that I have as when we kind of looking at like the Austin environment, and as more capital is kind of flowing in and where we want more activation happening, is how can the angel groups be more part of that? Or is it almost this kind of dual ecosystem that's kind of coming up, is that the companies that are going through and getting angel capital through these different types of groups, are they really a different set than the ones that we'll be hearing about as unicorns in 5 or 6 years? And like that's getting at the core of kind of the question why I'm asking some of this, because when I look at other areas and other places, putting Silicon Valley aside for a moment, but even in that case, I see that a lot of those companies that go through those are going through individual angels and syndicates and super angels, not so much the groups. That's the question I really have.
Yeah, I think there's two parts to that. I think one is most angel groups don't actually track their metrics. And so it'd be hard to say what was coming out of an angel group that maybe was a unicorn that an angel group never accounted for or never publicized because they haven't been keeping track of their investments, which it sounds archaic, but a lot of angel groups don't. And so at CTN, going to your next point, we go from beginning to end in 7 weeks. So the first 3 weeks is really meant for the entrepreneurs to go through our funnel. We review the startups, we select the top companies, and we have an elimination process. So they know within those 3 weeks, each week, whether they're moving on to the next step or not. And then the last 4 weeks is meant for due diligence. So if you call it a 7-week period from beginning to end, this is on par with most VC groups. And I'd say we do this as well as anyone. We have the metrics to back it up with a 4.6x return and 30% IRR. And this goes to us having processes and systems We have dedicated headcount to manage the organization, and then we're able to lean into 140 of our members to help us go through this process efficiently. So I think saying angel groups are slow, that might be a little bit of old thinking, because a lot are coming out. There's a lot of new technology coming out that we're able to leverage that helps us get the deals funded quicker, and at the same speed as most groups. Maybe pre-seed funds, they'll make a decision based on the founder, they won't do due diligence, but doing a full due diligence report and putting them through this process in 7 weeks, I would say, is a fairly reasonable amount of time.
Yeah, I see a lot of angel groups trying to speed up the process. They'll do a capital call at the beginning of the year. Everybody puts in their allocation. They have a vintage fund, and then they can start to deploy out of that. And then it's just one check to the founder when it's time, as opposed to the founder running around trying to pick up all the 50, 25K checks from everybody in the group. And found that really speeds up the process if you can do that in advance. And that's becoming more and more popular.
Yeah, I'd say that's a method that NuFund has employed with an annual fund, where they're able to deploy capital much quicker. Angels can deploy alongside that, but there is a decision, a go no go decision from the actual fund, and that just makes the process faster. Like was mentioned, it doesn't have to be 10 capital calls for 40K. You can just put the check in. That being said, I don't think you're ever going to beat we'll give you 500K over lunch tickets. That's just not the nature of angel groups. And I think there are plenty of pre-seed investors who are less valuation sensitive, less diligence sensitive, and more confident in founders that they can hit those. It might not be the case that angel groups can do that, but I don't think that necessarily means that they can't have good investments, they can't have good outcomes. If you're shrewd and sophisticated with all of this stuff, you don't have to be hitting unicorn after unicorn after unicorn to have a 30, 40, 50% IRR for a fund. You just have to be very, very regimented on how you invest.
So I want to pivot a little bit to Austin, and kind of as we talk about in general, what is your take on the kind of the angel funding environment? And I kind of want to actually start with you, James, is, with NuFund now opening up the node here, and I know that, I was asked to kind of speak for NuFund, but, as you were kind of one of the people behind the selection here and opening up, what was the thought process, behind that? And what was your take on the funding environment?
I'll start with, I'm relatively new to Austin. I've only been on the ground for about a year, and I have to say it's pretty awesome. It's a very welcoming place. There's still a lot of transplants here. There's a lot of tech-minded folks or tech-focused folks here, and so it's candidly been a blast after spending about 10 years in the Bay Area. What was so attractive to me, and I think NuFund as well, about Austin, is that it's very uniquely itself. It's not trying to be Silicon Valley South. It's not trying to be London or New York City. It has a really, really unique character, and trying to further that versus replicate or emulate something else is really important. There's also a lot of capital coming here. I think if you look on a map and say, oh, this is the capital that was raised in Austin, I think you're going to massively understate it. I think the capital deployed here is much larger than that. So looking at the stats within the stats is another important thing, and just the openness of opportunities, the openness of entrepreneurs to come meet, sit down, and chat with folks here. I would say if I have any criticism or commentary, I would say it's a lot of really early stage teams raising with a deck that says, if we get funding, then we'll do this full time. And so that would be my only rub thus far.
You've been around for a while.
Yeah. No, I see Austin as being very open to other industries, not just software. Some places you go, if you're not software only, they won't talk to you. But Austin will do many things. Over the years, we've done funding forums for films and funding forums for video games, and started accelerators in consumer product goods before that was a cool thing. And so you'll find that I think Austin's just very open to what might be a good opportunity versus what's just currently the hot topic. So I think Austin has a lot to say for that.
Katie, what do you see the kind of the angel funding environment? Is it been kind of going up and down the same track as the venture funding? Is it kind of on its, been disassociated and kind of on its own? How would you kind of see it going?
Yeah, I mean, Austin's really interesting, and especially when you look at it from a founder perspective. So we consider ourselves generalists, so we see all types of deal flow. We don't do pre-seed, so if a company's not raising more than 250K, they're typically not a right fit for us. If they're raising more than 4 million, we also won't look at them. One big different thing that angel groups are all adopting is they won't invest in safe notes. So I think that takes out a huge group of the Austin entrepreneurs. That's still fundamentally, one of the common things that early stage founders are doing. So that's something new within groups is it has to be convertible notes or equity. But being generalists, we do see all types of deals. We don't, I wouldn't say our interests correspond too much with VCs because we do serve 140 of our members. But we are able to compete at some level with the funds because our average check sizes are $600,000 as a group if they make it through our due diligence process. So if you look at our portfolio, what we've done is about 27% B2B software, 20% life sciences, 19% B2C software, 18% hardware, and 16% CPG. So it's pretty evenly distributed across those industries. But lately, we've been seeing a ton of life science deals, but really what's been happening is our deal flow just continues to increase and increase. So I don't know if that's tracking with less funding coming from VC, so more people seeking out angel groups or just more entrepreneurs moving to Austin. But our metrics are all, going to the top right. So it is interesting to see what kind of deals are coming through our platform. And then what our members are interested in moving forward at each step has also been surprising.
So I want to ask a question about the safes for a second. James, does NuFund not do safes?
I think generally speaking, there's an aversion in angel groups to safes. Call it an allergy. I think it's a bit of a funny one, to be completely honest. I don't know very many people who've been burned by safes. I think people don't like the instrument, but they couldn't tell you why they don't like the instrument.
So here's an interesting. So as soon as you said, I pulled up some Carta data. So for Austin, this is from January 2023 to May of 2024. According to Carta, 72% of pre-priced rounds were on safes. So that means that you're seeing almost none of the deals if the angel groups are saying we don't do safes.
What round was that at, though? Sorry if I missed that.
This is pre-priced. So this is basically it's
Pre-priced,
pre-priced.
okay.
So and then it breaks it into safes and convertibles. So 72% was on safes, 28% was convertibles, and this is Austin specific. So that's an interesting. If the angel groups don't do safes, they're missing a huge majority of the deals.
Well, there's two kinds of safes out there. There's the pre-money safe and the post-money safe.
Yeah,
I find most investors are very much up on the post-money safe because they invested in a pre-money safe. The entrepreneur raised more than they said they were going to, and the investor got diluted, and they didn't get the conversion they thought they were going to get. So the first question I hear from most people is that a post-money safe? And while there's other issues with safe, it's really technically an equity instrument. You should be registering it and so forth. That's the main issue I find is the conversion is just not happening the way they thought it would. But you're right, safes are everywhere, and you really have to kind of play with it. And I'm just coaching everybody, get to a post-money safe, and you'll have less problems all around.
Yeah, it's kind of back to our question on selection bias is if the angel groups are just turning them off, if kind of as a whole saying we don't do this, then it's an interesting case of what the kind of back to the question of are there two different ecosystems kind of running around?
Yeah, and potentially. So, go ahead, James.
I was going to say, I think it's a bit of the stage that's the best fit for the venture group as well. I think that gun to my head, I wouldn't say that angel groups excel in pre-seed deals. I would say seed and Series A are really where they seem to do better. And so I don't think it's the end of the world avoiding safes for that. If you're looking at only pre-seed and you want to be the first capital, then yeah, maybe you're gonna have to do a few more safes. But what Katie said, if they're writing $600,000 checks, I mean, you can throw your weight around if that's your average check size. If you're in the $500,000, you're probably on the smaller side of Series A. But if you can get well over that $1 million range, you can compete with the Series A funds. And that's really where I think there's a gap in the current market. And so everyone has their criteria. I don't think that saying, we're not going to do safes puts you out of the market in any way, shape, or form. But yeah, if you're at the earliest stages, I think you're probably at a disadvantage. But I don't think, look, NuFund is not always the first capital in. And so them saying, hey, we're not going to do a safe, but we'll lead around and we'll give you $500,000, I think that's a bit of a different calculus.
Yep. And I would echo that. James. So, yep, most of the time we're leading rounds these days, which has been great because we've had more members, we've been able to write larger checks. So, if a founder does come to us and they're raising on a safe, then as long as they're okay, if they make it through our entire process, converting it to a convertible note or equity with that round size, then we'll give them a fair squeeze. So it's not writing them off; it's just educating them that and there's so many forms of safes, like Hal said, so many different things that you could put into the safe to provide more protections or interest rates or maturity dates and all those. But it's just as a blanket, if you come to us with the YC safe, we're probably going to ask you to add some stuff in and adjust it.
So I know you mentioned, Katie, like that you guys are a generalist fund, but are you seeing changes recently in the types of companies that are coming? Like, is the trend changed? One of the things I've seen, there was some data out from Carter that I actually just yesterday, that it was interesting. They split it between physical and digital. So digital being very classic SaaS, ed tech, fintech, and then digital being bio, hard tech, defense. And what was interesting is it was the Bay Area, New York, and Austin were the only three cities that had both slots basically being within one ranking of each other. So like Bay was obviously 1 and 1, New York was 2 in one of them and 3 in the other, and then we were 5 in physical and 6 in digital. Everybody else had these wildly different. And so it kind of fits more, I think, is, we really are this kind of convergence of atoms and bits. And I'm curious if you guys are seeing that at the angel round.
So we still see tons of different industries coming through our pipeline. I think what's been more popular the past 2 years has been life science deals, but that's also because two of our biggest exits have been in a life science and a hardware company. And so when you have members who've seen those returns recently, there tends to be more interest in those specific categories. But if you look at our portfolio and how we've invested over the past 18 years, I would say it's pretty close in terms of what we're doing across each of those industries, which are B2B software, B2C software, life science, hardware, and CPG, which is how we internally categorize it.
Yeah, we see a lot of life science coming through now, and for two reasons. One, the cost of starting a biotech company has dropped dramatically. It used to be $1 million. Now it's $100K to get something off the ground. And then AI's in there as well, creating new targets for people to go after. And there's a lot of things to change the business model there with it. But the real factor is like Katie said, is the exits are truly spectacular. You can add 1 or 2 zeros onto it if you're in the biotech space, if it hits. That's the caveat. But we're seeing that's over half our deal flow now, just because there's such a wave of that coming out.
From my perspective, I think just because of where NuFund has historically sat, predominantly San Diego, you see a lot of hardware startups. You see a lot of biotech, whether that's physical, whether that's actually drugs, whether that's devices. I don't know that NuFund as a group has any sort of aversion to hardware, software, or really preference. I think it's a bit of changing taste around the industry in general. I mean, if you tried to raise money for a hardware company 12 years ago, 15 years ago, you get laughed out of a room. Well, NVIDIA has been doing okay, and they make hardware. So I think that's part of the sentiment shift, but also the understanding that you can exit a hardware company at a really, really healthy multiple and a healthy return. Also can be said for biotech and the like. So I would say broadly, it's no different. We see kind of half and a half from my perspective.
What do you think is the biggest challenge that we're facing here in Austin for the environment? Is it just scale? We need more people writing checks? Is it kind of it's fragmented, like the deals and capital aren't finding each other? Velocity, we've got startups growing at a good clip and capital's just not growing fast enough. Something else?
I haven't talked to a lot of people, and this is not Austin specific, but the last 3 or 4 years, it's not a lot of folks who've had that really, really big win. It was, 6, 7, 8 years ago, you met the person who did Uber's seed round, who invested in, an AI company that, happened to turn into something that Uber bought, or something that Google acquired for, 10,000x revenue. And so I think once we have more of those really, really big winners, that creates more capital that's looking for more early stage, high risk stuff. And so if you can get those first big winners or folks in the ecosystem with those, I think it's just cumulative and exponential long term.
It's funny. I've looked at the history of kind of Austin, and there was like an inflection point in the 2016, 2017 period. And after digging, there seemed to have been a bunch of exits in that period,
Okay.
like Home Away and others, and like that spawned then Zen Business and other things. So that next round that seems to be just at the cusp of coming here in Austin as well will probably spur another big uptick.
I mean, those are real. Like the classic is the PayPal mafia, right? I mean, that the amount of capital that's been generated by the folks who were early there, who made money there, is hundreds and hundreds of billions of dollars, and that's a pretty remarkable feat. And so I'm not pretending that we'll get that, but some influx of capital into the ecosystem like that is just fantastic for it long term.
There actually seems to be quite a bit of the Palantir and Anduril talent base and SpaceX base that is growing a lot of our defense base here. Hal, what do you think about the challenge?
Yeah, no, I think it's velocity. I think when new things come up like AI, it's just hard to keep up with the growth because there's so much going on there, and it takes time to form the capital to get up there. We don't have huge deep pockets, but there is good money to be had here for sure. So it's just trying to keep up with the growth that where it really takes off.
Yeah, for C10, I would say that I think there's just so much noise in the space. I could probably articulate maybe 30 different angel groups in Texas alone, and only a handful of them that are viable. I don't think the entrepreneurs, when they're looking for capital, know how to differentiate between these different groups. And there's probably 350, maybe a little bit more across the country. So I don't think it's a scarcity of capital. I think there's actually more probably available than there ever has been. But I think everybody's looking for the best companies to invest in. So I think like to cut through the noise is just about educating the founders on where to go to get capital, how to most efficiently connect with the different angel groups, especially since everybody has, such different processes. Some people do individual checks, others have funds. I think we have 3 different models already just on this call alone. And then also connecting and educating best investors on what groups they should join, what they're looking for. Everybody has their different thesis. Everybody has a different way of running their organizations. And so really educating both sides to make sure they know how to best find the angel group that suits them.
So I always like to end with the same question. I'll start off with you, Katie. What's next, Austin?
Yeah, so our main focus is just doing a really, really good job in Texas. So that really means making sure that Texas-based startups have access to angel level capital, and that investors, if they want to get involved in early stage investing, they know how to get involved and where to go. So that's really our main focus.
I see life science and deep tech. I find a lot of people are very much into deep tech these days, and there's a lot to be had for that. There's a lot of technologies coming out, a lot of support from the government. And Austin's, right there with the bits and atoms, as you once said, that they can be a part of both of that. It didn't have to be one or the other. So I think those are the two we'll see really taking the forward in the next 10 years.
I would say really just continue to do what defines Austin as a city. It's been really good at blazing its own trail in a number of unique industries. And just because it's not something that someone on Sand Hill Road wants to fund doesn't mean it's the wrong thing to be building. And have conviction in that. Be able to fight, have that conversation and say, no, this is right and you're wrong, and I'll show you why, and I will prove to you why. That's what's been so refreshing about being here and seeing all of the entrepreneurs that are willing to do that. I think Katie touched on a great point. It's being able to connect the right entrepreneurs with capital. I think there's a lot of really interested angel capital in this space, but it doesn't quite know how to access it. Entrepreneurs don't quite know how to get to these angel groups, and do they just spin their wheels for 20 weeks and end up nowhere? So being open, being available, anyone listening is happy to, connect with me on LinkedIn, talk through it. I think everybody here is available for the educational process, because that's how the ecosystem gets better, and that's how we make the ecosystem better.
So what's next, Austin? We're glad you've joined us on this journey. Please subscribe at your favorite podcast catcher, leave us a review, and let your colleagues know about us. This will help us grow the podcast and continue bringing you unique interviews and insights. Thanks again for listening, and see you soon.